So getting back to our scenario, the one that we've laid out, that simple exercise, there are only a few creditors, no complicated contracts to break. And so we'd likely first at least try an out-of-court restructuring. So imagine you get all the lenders and vendors in a room and you propose the following plan. Here we're talking about 40% claim reduction to the first lien holders, a 60% claim reduction to the second liens. But of course, the second liens, you're also proposing, hey, you're going to get 400,000 shares of equity. Remember, there's 120,000 shares of common equity currently held by you. You're the only shareholders or I should say you and some new shareholders you brought in, right? You put in 90, whatever it was, 90 or 100,000 of your own shares, and then another 20,000 you had an offering. So an additional 400,000 shares are now going to be owned by the second lien. So you're willing to get yourself heavily diluted, even further diluted, because you're going to take a 60% claim reduction, or you're proposing a 60% claim reduction for the unsecured notes, and you're going to give them 200,000 shares to make up for that a little bit, or at least partially make up for it. Then you're telling trade, hey, those payables that we owe you, we're only going to give you 50 cents on the dollar. And obviously with equity, you're not proposing any change. Essentially you are, because you're diluting yourself heavily, but you're not saying, hey, I'm going to give up my shares. I'm just going to dilute myself pretty significantly. So you tell everybody that this is your idea of a best plan, and unless they're all willing to agree, you're soon going to run out of cash, and you're going to have a fire sale liquidation, leaving them with even less. So you're saying, what do you guys say? Let's do it. Now, what I'd like you to do at this point is analyze the restructuring proposal. Number one, assuming they all agree, will the company remain insolvent? In other words, is this proposal actually going to cure the distress or the insolvency? Also, I want you to quantify, what is the aggregate recovery, both debt and equity together, proposed to each claim? So the recovery here is going to be pretty straightforward. It's just a 40% claims reduction, so you're going to get 60 cents on the dollar. But what's the recovery here to the second liens and to the unsecured? The third question that I want to answer is, who are the equity owners of the business now? In other words, how much do the second lien owners own now? They're going to become equity owners. In fact, it looks like they're going to be the majority owners of the business. What portion of the entire equity pie do the unsecureds own? And what portion do you, the original shareholder, along with some of the others that were part of the secondary offering, how much do you guys own? So let's list that by percentage ownership. And then fourth, just your opinion on whether this is a good proposal or not. Who do you think, which of these claims do you think might be happy? Which of these claims may be unhappy? So let's give that a shot. So the first question is, will the company remain insolvent? And it does appear that this restructuring plan does fix the problem, right? So if you look at what this plan is suggesting, you're talking about a 60% discount for the second liens. We'll kind of go backwards, and a 60% discount to the unsecured note, right? So we're talking about 160 claim instead of 400, an $80 claim instead of 200. Here we're doing a 40% discount on the $100,000 first lien, so they get to keep 60,000. Accounts payable is 55,000, so that's a 50,000. That's a 50% discount on the 110,000 in accounts payable. So now your total liabilities, if everybody agreed, were only $355,000. And of course, if we believe that the asset value, goes back to our DCF analysis and our sense of what this business is worth, is $452,000. Well, that leaves, again, this is kind of by implication, $97,000 worth of equity in this business, which if you kind of run the numbers, that's a 38% debt to EV rate of leverage. Now that may be too much for some industries or for your company. Again, the amount of, is this sufficient? Is there sufficient equity cushion here? Is always in the eye of the beholder. But it does appear, at least, at a 38% net debt to EV ratio. And again, just as a note, you might be wondering, oh my God, we have so many liabilities. How's this 38%? Well, net debt nets out cash, and we've got a lot of cash on our books. So it does appear, at least, to no longer have, for the company to no longer be suffocated by debt. It may still be more debt than you'd like, but it appears to have solved the insolvency, at least to some degree. All right, so this plan to restructure the debt does appear to somewhat solve the insolvency. Okay, what is the aggregate recovery to each claim? Well, for the first liens, as we talked about, we're talking about just a simple 60% recovery because you're exchanging it for 60,000 in debt. So 100,000 in debt becomes 60,000 in debt. They get 60 cents on the dollar. The second liens had an original claim of 400,000. You're proposing a $160,000 debt exchange, and then equity value that amounts to 56% of 97,000 in equity. Let's kind of think about how we got to that figure, right? So the way that we got that is we recognized, okay, these guys are getting, unsecureds are getting 200,000 shares of stock. Second liens are getting 400,000 shares of stock. You had 120,000 shares of stock. Together, you're talking about 720,000 shares of stock. So now all you have to do to figure out how much each one owns is divide their equity ownership by the total number of shares. So the second liens own 400,000 divided by 720, or 56% of the equity ownership. Well, now the equity ownership has a value, as we just saw, of $97,000. So what's 56% of $97,000? That's $53,900. So right. So if we believe that this business is worth $452,000, then we believe there's $97,000 worth of equity. That's a key kind of conceptual thing to understand here. If we believe this business is in fact worth $452,000, then we believe, given that there's been an exchange and there's only now $355,000 worth of liabilities out there, that there's $97,000 in equity in this business, which means that you, as the second lien, own $53,900 worth of equity value. Add that to the 160,000 debt exchange, you've got $213,900 in total value on an original claim of 400,000. That's slightly over 50% recovery. We do the same thing with the unsecureds, and we get to 53% recovery for them, right? So they got an $80,000 debt exchange, so 40 cents on the dollar, but of course they got an equity infusion as well, where now they are 28% equity owner of this business, which provides about $96,900 worth of equity value. The trade got the lowest of everybody, just 50 cents on the dollar. They weren't offered any equity. So these are the aggregate recoveries for each claim, and these are now the equity owners of this business. Obviously, the second lien is the big one, is the big new equity owner, and you are heavily diluted. You now only own 17% of the business. Notice you weren't wiped out. You cannot just be unilaterally wiped out, but you can offer to dilute yourself into essentially being wiped out. In this case, you left yourself a good chunk of equity. So how is everyone going to feel about this plan? Is this a good proposal? Well, I think the first liens are probably going to disagree. They're not going to approve of this plan. And the reason is they have a $100,000 secured claim, which gives them priority. And we're going to talk about priorities in just a second more specifically, but this gives them priority over everybody else. A first lien, 100,000 secured claim should give you priority over everybody else. In a bankruptcy process, you would be first in line. And given that we have $452,000 worth of assets, of which $250,000 are in cash, they can reasonably expect to be paid in full in court. So they would say, no way are we going to take a 40% haircut to get to 60 cents recovery on every dollar when we could do much better in court. So they would probably disagree. How would the second liens react? Well, the second liens recover exactly as much as the unsecured note. They might argue that they should get priority because they have a second lien on the collateral. So do they have priority over the unsecured note? I'm going to leave that as a question mark yet, because at this point, because we have to actually really understand priorities and how that works to answer whether these guys should get any sort of priority over these guys. The answer is not as simple as it may appear. If you think, they are secured, so they should get priority, that may not be the case. So let's put a pin in that for a second. The unsecured notes get as much as the secured creditors, or at least the second lien creditors, despite being unsecured. So I imagine that they would probably be okay with this. And trade, the question is, where do they fit into all this? Should they have the same status as the unsecureds, as the second liens? Why are they getting less than these? So we have to answer these questions to figure out how everyone else is going to be, how these guys are going to feel. The only thing that I think is fairly clear is that these guys are going to be unhappy. The final thing is your proposal leaves you with significant equity, 17%, and that might anger lenders. Why should you have anything when these guys are getting such massive haircuts and they're they should be in front of you in the priority ladder. So for a more complete answer, I've been kind of foreshadowing this, we now need to understand bankruptcy. If parties think that they can do materially better in court, they will not agree to this. And as a result, an out-of-court restructuring is driven very much by the bankruptcy framework. Everyone in this out-of-court setting is always thinking about how they're going to do in the bankruptcy, because if they do materially worse in this out-of-court proposal, they're just not going to agree.